how are you? I hope you'll be fine. So today our topic is how CEOs legally avoid millions in taxes. In 2026 Tax Playback, first of all like my video and subscribe my channel for more informative videos. So let's start. So here's top 10 tax planning strategies for 2026 and business are approaching the end of the first quarter of 2026 with a familiar feeling. The rules are still shifting, the economy is still sending mixed signals, and wait and see is no longer a verbal strategy. So a major driver of action is as you can see is the One Big Beautiful Bill Act, and here's which deed of important changes that are now live for 2026 and are already reshaping how business think about tax planning at the same time, and the broader business backup, and you can see is giving those rules change about tax planning. At the same time, the broader business backdrop is giving those rules change extra by drawing cost remains a meaningful factor in deal modeling. So here's you can see those rules change extra by drawing cost and remains a meaningful factor in deals, and driving those rules whose change extra by drawing cost remains the main meaningful factor in deal modeling and cash flow planning. And the Federal Reserve has been clear that policy will be calibrated carefully as inflation cools and growth normalize. So in a market that hungers for the suddenly business needs tax planning and hers carefully as inflation causes and growth normalization, and in a market that's hungry for suddenly business needs tax planning strategies that offer clear and immediate value. Also, fortunately, favorable guidance, new court decisions, and legislation changes are creating a meaningful planning opportunities across the nearly every business type and industry. Wherever your company is focused on cash, tax saving, and effective tax rates, honor taxes, or M&A activity that are planning options that fit your profile. See below our top 10 tax planning strategies for 2026, including opportunities for tax players losing the charitable deduction and struggling with tariffs, and recovering research costs and seeking tax efficient M&A structure, operating across border, facing self-employment tax, and looking for credit opportunities of to offset tax and liability. So corporate the charitable deduction and the corporate your proactive planning might spur many corporations from losing valuable deduction under a change made by the OBBA. And beginning in 2026, corporation will be able to deduct the charitable gifts only to the extent and your cap on the corporate and charitable deduction, the amount dissolves. So here's your example. So the IRS and the court for the provider extensive guidance in when payments to the charities and the property. So here is the property deductible and charitable gifts or business expenses. IRS regulations generally provide that a gifts is the deductible as business expense if there is a direct correlation with the taxpayer trade or business, and there is a reasonable expectation that the gift will result in a financial benefits of equal or greater value to the business. So this financial return could be as simple as a goodwill advertising to keep the taxpayers named before the public, such as the sponsorship or giving program that is the advertised as a part of the marketing campaign, and contribution may also qualify if they are made to strengthen customer relationship, improve the general business condition, attract and retain employees, and hers employees are satisfying the regularity or licensing obligations And the analysis required to determine how a payment to a charity is deducted in very fact conditions. So next you can see is the demonstrate an expected business return. So it will be important to contemporaneously documents the business purpose, the expected returns, and how the program will archive it. Research capitalization. Be careful what you wish for the business community and spend years advocating for low markers and reserve the legislation that requires a business and to capitalize research and experimentation cost for tax years beginning of 2021 and your ending and domestic R&E costs. May business are realizing capitalization, still others them are better results. So there are several reasons a company may benefit from the capitalization, including the increased ability to use tax credit or other tax attributes, and a highly leveraged business should consider the interaction between R&E cost recovery and the limit on the interest the deduction under Section 163J. Capitalized cost will not reduce adjust taxable income for purpose for a Section 163. So next you can see the complex interaction between the provisions make modeling the key to identifying beneficial strategies. Taxpayers will generally have two options to capitalize domestic R&E costs. So tariff refunds before and after. The Supreme Court's decision striking down tariffs imposed under the International Emergency Economic Power Act is not the end of the tariff story. It's the beginning of a new chapter. The Trump administration has made it clear that tariffs will remain a central trade policy tool. It has already implemented 10% worldwide tariff under section. So is a duty drawback. Companies may be eligible to recover up to 99+% of duties, taxes and fees paid or imported goods that are later exported, unused, stored, or incorporated into exported products. Comprehensive import, export, and production data reviews can uncover significant refunds opportunities. So, first fail rule. Importers may be able to declare transaction value based on a earlier sale in a merger simpler chain. Even companies with a single sale structure may consider establishing a trading entity or intermediary to take advantage of first scale valuation. So, cost unbundling. Companies should evaluate whether specific cost elements such as certain management, service fees, exclusive distribution rights fees, and bona fide buying, commission, and certain US-based R&D costs can be excluded from the custom value. So, collecting relevant entry data from ACE and identifying entries that paid duties under the IAEPA. So, monitoring the continued updating for the horse and the agency as the review process launcher. So preparing to receive refunds electronically, which CBP has status required for processing. So self-employment tax refunds. Ongoing litigations may provide an opening for some partners to claim refunds for self-employed tax, and particularly in the fund space. Partners are generally subject to SE tax on partnership income unless a specific expectations applies. The expansions of exceptions of limited partners into in a limited partnership has been the subject of the controversy of many years. So next you can see the qualified small business stock. So the Q will be A is significantly enhanced a tax efficient and structuring option of the private companies qualified small business stock under section 1202 and offers the potential for tax-free appreciation and has become an increasingly attractive option for the private equality. So next session, in this session generally allows on is a corporate taxpayers to exclude 100% of the gain on QSBS and stock held for 5 years up to stated limits for stock issued after July 2025. The QB also allows 50% exclusion for stock held for at least 3 years and 75% for stock held at least 4 years. And next, it's offer foreign tax credit planning. The evolving foreign tax credit FTC rules has made FTC planning both more challenging and beneficial. The FTC rules were modernized in final regulation published in 2021 and then temporarily undone by temporary. So I hope you understand. Thanks for watching this video. Like my video and subscribe my channel. Goodbye.